Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, on one mutual fund per video to share how an individual investor like you and I can try to find out more about a mutual fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I am not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about BlackRock's BGF Asian Tiger Bond Fund. Now, the first thing we need to figure out as an individual investor is where can we obtain information and documents on the fund. BlackRock has a Singapore website and doesn't differentiate between retail and professional investors. The website contains majority of the fund information, although there are some stuff that are lacking, which I will go through. I also found a little bit more information on the fund from other BlackRock websites, which I will mention later. FundInfo is a global third-party consolidator and service provider for fund data and documents, and has information on at least 90% of the mutual funds offered in Singapore. So if there is a need, we will be checking the information on FundInfo as well. As you can see on the screenshot, the fund has 41 share classes registered in Singapore, but many are actually not meant for retail investors. You can, of course, also get some information from your distributor, which is your bank or online platform that you buy funds from, as long as they have the fund on their offering list. And finally, the web is always readily available, waiting to answer your search queries. Before we go through the fund details, let's spend a quick moment to understand who the fund provider, BlackRock, is and what they are good in. BlackRock is a US multinational investment company that is the largest asset manager in the world, with over $10 trillion worth of assets under management. The business spans over 100 countries and employs nearly 20,000 people in the firm. BlackRock's business covers nearly the full spectrum of investments for investors of all types, from passive ETFs under their famous iShares franchise, to active mutual funds, to private investment products, and as well investment and risk management technology solutions, with their Aladdin solution well regarded in the industry. About half the AUM comes from institutional business, 1/3 from ETFs, and the remaining from retail investors. Equity solutions form half the business, while fixed income owns nearly 30%. Alternatives and private solutions look small on percentage basis, but is still a decent size in dollar terms. About 2/3 of the AUM comes from US by client region, while Asia Pacific contributes less than 10%. Specific to Singapore, there is not much details, but BlackRock cited in their website that they have close to 20 years of presence in Singapore, with 700 employees in the office currently. With obviously a wide list of investment products available, BlackRock is a frequent name when it comes to winning awards. Now that we have gone through the background of BlackRock, let's take a look at the fund. The BlackRock BGF Asian Tiger Bond Fund is a sub-fund under the BlackRock Global Funds, or BGF, fund family. The current BGF prospectus has 101 sub-funds, which shows again that BlackRock has a wide variety of products available. The Singapore website provides a rather simplified description of the fund's investment strategy. The fund is supposed to invest at least 70% of its assets in fixed income of issuers domiciled in or having main businesses in Asian Tiger countries. This is the main reason why the fund is named Asian Tiger Bond. Going by commonly accepted definitions, there are only 4 Asian tigers, namely South Korea, Taiwan, Hong Kong, and Singapore. So the fund would have to be quite concentrated in exposure if it needs to have at least 70% invested in bonds that are domiciled or have main businesses in these 4 countries or cities. maybe the fund will cheat a bit and include the 5 Tiger Cups, which are Indonesia, Malaysia, Philippines, Thailand, and Vietnam. But let's see the portfolio construct later. The descriptions below the investment approach provides some additional information on the strategy, which states the fund is a core, credit plus, Asian hard currency strategy. By core, it usually means to focus on liquid investment grade bonds, but the prospectus states it is allowed to invest in high yield bonds with no limits. Credit plus is quite big, but sometimes means that the fund deploys some additional approaches to enhance the credit quality or the returns, for example, via leverage or derivatives. There are no definitions or explanations provided, so we can only assume here. The prospectus states the expected leverage is 150% with no limits as well. Asian hard currency means the fund is supposed to invest primarily in Asian bonds denominated in G7 and other stable currencies, for example the Sing dollars. So while there will be some currency plays, it should not involve the more volatile local currencies of some Asian countries. The next part is a bit confusing. The fund is supposed to provide stable income whilst protecting on the downside. Stable income is easily achievable, as most bond funds provide smoothened monthly distribution share classes. Protecting on the downside is, however, challenging, as there needs to be some kind of risk management focused approach to do so, and there is again no elaboration on how the fund plans to do this. Having run out of information in the Singapore website, I tried searching in other country websites. The Hong Kong website interestingly has an additional fund flyer document available that comes with a slightly different tagline, which says Core Asian Credit Strategy, offering attractive all-in yields at relatively low volatility. There is no mention of protecting on the downside, but instead relatively low volatility is used. Reading a bit more, we can see the low volatility is actually referring to the volatility of the Asian credit market compared to global and US credits, and not saying that the fund is having a lower volatility than its benchmark. So investors need to be careful with this in case this is misunderstood. Unfortunately, that's all I can find from the public access of BlackRock's websites. It still looks a bit iffy, but let's see how this translates to the actual fund portfolio. The BlackRock Singapore website provides quite a lot of data on the fund portfolio, and some are more detailed than the fund fact sheet, so I will be grabbing screenshots from the website most of the time. The BGF Asian Tiger Bond Fund was incepted in 1996, which gives it almost a 30-year long track record. Fund size is over $2 billion currently, which is quite sizable for its strategy. Base currency is US dollars, and the benchmark is JP Morgan Asia Credit Index. Let's start with the most important breakdown, which is by geography. The fund portfolio looks quite different compared to the benchmark, with big overweights in India, Australia, and Macau, and big underweights in China, Hong Kong, Indonesia, and South Korea. This shows the fund is not required to follow the benchmark at all. But wait a minute, doesn't the fund strategy say it's supposed to have at least 70% invested in bonds domiciled or have main businesses in the Asian tigers? If I take Hong Kong plus Singapore plus South Korea, I get only 18%. There is no Taiwan in the list. If the fund cheats a bit and includes Tiger Cups, that means I add only another 17% from Indonesia plus Malaysia plus Philippines plus Thailand. There is also no Vietnam in the list. That's still far off from the required 70%. Additionally, the fund has big underweights in Hong Kong and South Korea, which is completely opposite of what the fund is supposed to do by strategy. The only possibility is that there is another 35% exposure of bonds domiciled in other countries but have main businesses in the Asian tigers or Tiger Cups. But without any evidence from BlackRock, this sounds very unconvincing. I feel it is quite disappointing if the fund does not follow its defined strategy, as I would not know anymore what I am investing into. Imagine you promise to buy your child his favorite chocolate ice cream, but gets him a vanilla flavor instead. If BlackRock isn't serious about the Asian tiger strategy, the fund might as well remove the tiger from the fund name and change its strategy definitions. Next, let's take a look at sector breakdown. The benchmark has almost half exposure in sovereigns, quasi-sovereigns, and local government bonds, which the fund significantly underweights in. This means the fund is primarily invested in corporate bonds. There are big overweights in consumer cyclicals and utilities, but without further elaboration, I do not have information on whether this is due to a top-down macro view or simply the result of bottom-up bond selections. Looking at maturity breakdown, the fund has the bond maturities spread quite evenly across below 7 years. Weighted average maturity is 4.59 years, which looks just slightly lower than the benchmark. Last but not least, the credit quality breakdown shows the fund is mostly concentrated in triple Bs, and there is actually about 31% of high yield exposure, which looks a bit high for a core credit strategy. Top 10 holdings as usual is not too useful for bond funds. In this case, the fund has over 390 positions, so it is well diversified. Useful to note is that the fund does utilize ETFs for exposures as well, which in this case, the iShares US Dollars Asia High Yield Bond ETF occupies about 2% in this fund. There is no information on currency breakdown or performance attribution by currency, which suggests the fund may be mainly holding US dollar bonds, and there is little impact due to currency exposures. Looking purely at the portfolio construct, the fund feels like it is an Asian net investment grade US dollars credit bond fund that is unconstrained by the benchmark. There is also some confusion in the data for the managers of the BGF Asian Tiger Bond Fund. In the BlackRock website, there are 3 named portfolio managers who are Stephen, Van, and Yi Hui. The Hong Kong Fund Flyer additionally lists Niraj as a manager, and as well indicated that Stephen and Yi Hui were new additions in May 2023 and had replaced Ronnie. Checking further via Morningstar website, it was found that Niraj started managing the fund since 2012, Van since 2021, and Stephen and Yi Hui indeed started only in May 2023. From this data, it seems Niraj should be the most critical person for this fund, so the absence of his name in the BlackRock website is puzzling. Also interesting to see from Morningstar information is that this fund has gone through many manager changes throughout its life, which is not really a good thing for investors. Googling found the bio of Niraj on BlackRock's website that shows he is the CIO and head of Asia Pacific Fundamental Fixed Income, and has been responsible for Asia fixed income business since 2009. So he would definitely be the key person for the fund. However, further Googling also found the cause of the confusing data, as Niraj had announced departure from BlackRock in October 2024. Therefore, his name has been removed in some places, but not all yet, as things get updated. Niraj is supposed to complete all his handover by early 2025. So the next most experienced manager for the fund is Van, who started managing the fund about 3 years ago. I had difficulty searching for Van's information on the web, and the only bio I found was from an event website dated 2021, which showed that Van joined BlackRock in 2012 and as of 2021 was a portfolio manager and ESG investment lead in the Asia fixed income team. BlackRock is big in ESG related matters, for better or worse, and looking at Van's profile, he might have been added into the managing of the fund to handle specifically on ESG related matters within the fund. Van also manages a sustainable Asian bond fund since 2020. It was also difficult searching for Stephen's information on the web. He does have some interview articles and videos on the BlackRock websites, so his current title is Fixed Income Portfolio Manager and Head of Asia Credit. Morningstar provided some additional history of his career, while some further Googling found that he moved from UK to Singapore in 2022 to take up the Head of Asia Credit role. Going by this job title, he should be the most important manager in the trio for the fund after Neeraj leaves, so it would be interesting to see if he makes any major changes to the portfolio in the near future. Stephen is also named as a manager for Sustainable Asian Bond Fund and Asia High Yield Bond Fund since May 2023. Searching for Yi Hui's information on the web is no easier. I only managed to find a photo of her on Asia Private Banker website, as the China bond fund that she co-manages had won an award, and she provided some remarks in the webpage. Yi Hui has been managing China Bond Fund and China US Dollar Bond Fund since 2021. A rather outdated bio of her from Googling showed that she had been in the Asian local currency fixed income space for over 20 years and has mainly been focusing on China. Given her expertise, she is likely to provide China-specific inputs as well as currency views into the fund. Again, considering BlackRock is the largest asset manager in the world, it has been a surprisingly difficult task to find information on the fund managers compared to most other fund providers that I have worked on. This is definitely something BlackRock can improve for the benefit of the retail investors. BlackRock's BGF fund family has many share class types. We will focus on the US dollars and Sing dollars share classes for Singapore retail investors in this video. Alphabet A denotes the normal share class for retail investors. The BGF Asian Tiger Bond Fund has a US dollars based currency, and all other currency share classes are currency hedged. BlackRock has businesses all over the world, so they usually have one of the biggest range of currency share class choices among fund providers. Some third-party websites use the alphabet H to denote hedging, while FundInfo uses RH for this fund to denote residual hedging, but does not provide any further elaboration. The number behind the A defines the distribution type, and this is where BlackRock makes it quite confusing. For starters, 2 represents accumulation. So A2 share class would be the usual share class I suggest investors to go for, if there is no need for income. For all other numbers, they each refer to a distribution policy which also has a unique alphabet. For example, 1 refers to distribution D, 3 refers to distribution M, and so on. It is puzzling why BlackRock doesn't use just one set of unique identifier. So anyways, A6 share class would be the most common distributing share class for Singapore retail investors. It has a smoothened monthly payout and is not supposed to pay an excessively high distribution compared to some of the other distribution types. So investors who do need income can consider the A6 US dollars or Sing dollar share classes. Anyone who is interested to understand more about the 9 different distribution types can read more in the fund prospectus. The A retail share class of this fund charges a 1% management fee and rounds up the other expenses to make the TER across all A share classes consistent at 1.21%. Up to 60% of the management fee can be paid by BlackRock to distributors as trailer fees. The fund also allows distributors to charge up to 5% subscription fees, although anything more than 2% for mutual funds looks excessive. Here you can see the recent distributions of the A6 US dollars and A6 Sing dollars share classes. As shown, the amounts paid out every month can be adjusted by the fund but are generally quite stable. Using a rough calculation of the latest payout amount with the latest NAV, Both the share classes have a payout yield of about 6.2% per annum. What this means is that the fund should generate a return of at least 6.2% for the year. Otherwise, it will need to reduce capital in order to pay out the distribution. Finally, let's take a look at the performance of the fund. Bearing in mind the fund seems to have moved from its intended Asian Tiger focused strategy and yet has substantial deviations from the benchmark, we would perhaps think the fund has found its own secret sauce to deliver good performance in the Asia bond market. The numbers we get from BlackRock website, however, shows a rather disappointing result. The fund has lagged behind the benchmark across 3 years, 5 years, 10 years, and since inception. On calendar year basis, the fund also underperformed the benchmark 7 out of 10 years. Year to date looks decent, although I'd be skeptical about whether this is a one-off. To be fair, this perhaps can be attributed to Stephen and Yihui joining the management of the fund from May 2023, and if so, this is a good restart from the poor run by the previous managers in the last decade. For comparisons, I have added the Sing dollar share class, and we can see that it lags behind the US dollar share class by about 1 to 2% per annum, which would be the hedging cost. It is also useful to note that the Sing dollar share class has only returned 5.74% year to date, which is still lower than the distribution yield. I have also added here BlackRock's own equivalent passive solution, the iShares JP Morgan US Dollars Asia Credit Bond ETF, for comparison. Putting the fund and ETF side by side, we can quite clearly see the ETF has a much less volatile, yet better performance over time than the fund. The fund delivered 1.39% per annum in the past 10 years, while the ETF delivered 3.11%. In the worst years of 2021 and 2022, the ETF lost significantly less monies as well. The benchmark numbers look slightly different, as the fund and ETF are using different versions of the JP Morgan Asia Credit Index as benchmarks. So, as investors, we have to ask the question, what is the point of investing in this fund then, when the fund seems to have deviated from its strategy and yet performs worse than an ETF? With that, let's summarize our findings and start with the good stuff. BlackRock is the largest asset manager globally. In theory, that should mean that it has the most resources compared to other fund providers to make good its products. Unfortunately, I struggle to find other good points to talk about for this fund. So let's move on to the bad and the questionables. My biggest issue with the fund is that it apparently has deviated or disregarded the intended strategy, which is to focus on the 4 Asian tiger economies. I get it that the Asian tiger concept is probably outdated now, and everyone sees China and India as the main drivers for the Asia region. So BlackRock might as well get rid of the tiger from the fund and update the strategy to make it a generic Asian credit bond fund. It was very difficult to find information on the fund managers, as very little is available on BlackRock websites, as well as on the web. The numerous changes in the managers responsible for this fund is a concern. Every manager will have his own investment style, so the risk is that the style of the fund might have already changed several times over the years. BlackRock has too many distribution share class types that probably should get a clean up. The fund's performance has been bad. With more than 10 years of track record, it showed the fund had higher volatility and yet lower returns than the benchmark. Even going for an ETF would have been better. As such, there really isn't a point to invest in this fund. Sure, it would be great if Stephen and Yihui can turn this fund around for the better, but that means another year or two of observation to see consistency, and hopefully no more frequent manager changes. This concludes my absolutely biased comments on the BlackRock BGF Asian Tiger Bond Fund. Would you invest in the fund or give it a miss? Or are you already invested in it? Do drop a comment to let me know what you think. Additionally, if you find this video useful and would like to see more related contents, please click on like, subscribe to the channel, and share this video to your friends. Thank you and have a great day.